Hey guys, it's Friday, so happy Friday. I hope you've had a great week in the markets. It's quite funny though, this time of the week is the time of the week when everyone starts reflecting on their trades from the past 5 days. And obviously we all know that if you want to be a professional trader or you want to be good at trading, what matters is your long-term performance. It doesn't matter if you have a losing day or a losing week. It matters like what your end outcome is after a longer period of time. That you can have these losses as long as overall you're up. But when you're learning to trade or you're like using your first live account or you're just new to something, the days and the weeks as individual periods of time seem to matter a hell of a lot. So this means there'll be some of you sitting there at the end of this week thinking to yourselves like you're just ecstatic. You've had the best week, you've traded well, you've made a profit or you've stuck to your system or you've progressed in a certain way. And there'll be others of you that are sitting there feeling super depressed. You can't wait till it gets to Monday so you can just redeem what you've done, like you've made mistakes or you've made a loss or you haven't made the profit that you should have made and you want to redeem yourself. So you can't wait for the weekend to go, you're wishing your life away. When can it be? Monday. Now, I get a lot of emails from people, obviously people asking questions about things, telling me about their experiences, asking for feedback on analysis and so on. And when you get like a high volume of emails about similar topics, you start to pick up on common themes, and from that you can find a root cause that is leading to these same issues happening every time. And so when people talk about their performance not being how it should be, or they're losing trades too often, or like they can't cut losses and all of this kind of thing, it ultimately usually ends up being because of position size, that they're using the wrong position size. Now, this isn't necessarily in the way that you think it is. It actually comes down to two main issues, and both of them equally affect people's performance. So the first one is probably the one that you're thinking it's going to be, that people are using position sizes that are too large. So I bang on and on about always having just 1 to 2% of your account at risk maximum when you're trading. And when I say 1 to 2%, I mean you should set yourself a cap and say no trade's going to be above that. And if the position's not that good, it's going to be less than that. Like if the setup's not good, I'll risk less than that, maybe 0.5%. And the more experienced you are, that cap can increase. So for me, I might have trades where I'm risking 2%. If you're new to trading, it should probably be about 1%. And people listen to me saying this and they agree and they say, yeah, that's what I'm going to do. And then it comes to opening a trade and maybe they actually look at where their stop loss is going to be and they see where they want to take profit and they're like, you know what, for this trade, I can make a bit more if I risk 3% or 4% or 5% or slowly it grows or people risk too much. And some people think, well, it's not much of a problem. Like, what does it matter if I risk 3% of my account? Is that a big deal? The answer is like, yes, it is a bigger deal than you probably think. So let's think about why we're risking 1 to 2% of our account. Like essentially, it's not because we are thinking that we need a buffer of 99% of our account in case there's slippage. Like, okay, that's maybe like one aspect that you want to protect yourself in case your stop loss doesn't get triggered and the price moves through it. But also, what about like the psychology of it? So say we're in a situation where you're risking like 10% of your account and maybe your stop loss is just like at the next wave in the market. So if the price starts going against you and it reaches that point where your stop loss is, and that's 10% of your account, then suddenly you're thinking to yourself, okay, if I'm risking 10%, that's going to take me a lot of work to get that back. And ultimately this is going to lead to loss aversion and you're not going to be able to close the trade. It's going to be really difficult to compel yourself to click that button and take that hit on your account. Because it's one thing if just 1% of your account is at risk and you accept that the setup wasn't right or something hasn't gone your way and you exit that trade, because you know that you only need to make 1% back to sort of recover that bit of an account and be back to where you were. Now, if you risk 10% of your account, when it gets down there, you know that your account's going to be 90% of what it was before, and you're going to need to make a lot more to get that back than what you would have had to do. So sometimes it's easier to stay in the trade. Also, in the next trade, you might not be able to have the same size of position size because you've got less money in your account, and you think, you know what? I'll hang into this trade a little bit longer in case it goes in my favor. And so what happens is that sometimes it works out for you and you recover and you're like, okay, that worked out well, let's not do that again. But you'll keep doing it and eventually you'll make a bigger loss. And as that loss increases, so does the loss aversion. And ultimately you end up burning out your account, hitting a margin call and having the broker automatically close your trade, or a number of very, very negative things. And that's not all, because even if you did close the trade at that bigger percentage, you have to consider what sort of percentage return you need to make to recover. Like for example, like I said, if you lose 1%, you just make 1% to make it back. If you lose 50%, you need to make 100% return to make that back. Now that's tough, and that's going to lead to over trading, to revenge trading, and a whole load of other negative feelings where at the end of the week, you're sitting there watching this video thinking, what the F have I done? But not all of the problems come from using a position size that's too big. That's the obvious one. That's one that you knew I was going to talk about. But there's a second issue, and it also leads to poor performance. It leads to a sort of loss of confidence in your trading. It can lead to over trading eventually and a load of other mistakes, because they all start from this problem and they build and build and build into something much bigger where it ruins your sort of prospects in trading. So this second issue is all to do with having the correct contrast between your different position sizes. Now, what I mean by this is that imagine you have a high probability setup. It's like right to the top end of your scale in terms of setups that you'd like to open a trade based on, and this one's high probability. And if you compare that to a lower probability one, where it's towards the lower end of your scale, it's still high enough probability with the risk reward and everything for you to have an edge and over the long term to make profit from that, but it's not quite the same as the high probability one. Now, you should be having a contrast in your position sizes. Not only should they not be the same position size each time, so it's not like 1% and 1%, but they should also be different enough that there's actually a big enough difference between the two of them. Because I see a lot of people that just are so nervous with their trading that they end up having small position sizes for everything. They're like, okay, I'm going to risk 0.2% on this, and this one's a high probability one, so I'm going to risk 0.24%. That's not a big enough contrast for you to really experience the benefits of having more money on the high probability setups than the lower ones. So first of all, very, very quickly, let's just remind ourselves of why we adjust our position size depending on the probability of the setup. And this all comes down to the chance of having a losing streak. So for example, if you have a probability that's like, there's a 55% success probability. Of course, that's going to be fine if the risk reward of the trade is like 2-to-1 or a 3-to-1 or that kind of thing. It's fine to have 55% success probability, but that also means that 45% of the time you're expecting that trade to lose, which means if you keep on going for that setup over the long term, you can expect there to be quite a severe losing streak there at some point in time. So it means that you might lose 10 in a row at some point, and yes, that can genuinely happen for some people. It's just probabilities. You can have that, like the streak of 10, and still over the long term be up, because over the long term you've got your edge. But you need to have a lower position size to be able to endure those sort of longer losing streaks and not create too much of a massive drawdown on your account that you're going to lose confidence and not execute those trades anymore. Whereas with the higher probability ones, if you've got a success rate on that sort of setup of 70%, and of course these are all estimates, but you base it on past data so you can have a certain level of certainty about that. If you've got, say, 70%, the chance of having a bigger losing streak is significantly reduced, so you can increase your position size. Because ultimately, our trading performance is not only on the number of good trades we open, but also how much we're risking and therefore how much return we get from those trades. So as much as possible, we want to maximize the sort of amount we have at risk so we can maximize our returns, but at the same time we need to be cautious. So basically at the end of a week, your net position in terms of pips might be negative, but your net position in terms of actual monetary value may be up. So overall you're making a profit. And so you need to have these contrasts, and you need to understand the importance of your position size, both from a positive point of view and a negative point of view. With trading, so many things are about balance, so many aspects of it. But when it comes to money management in particular, you have to get that balance absolutely right in order to be able to maximize your profitability over the long term. That balance between having enough at risk to be able to get a good return and not having too much at risk that you're going to have severe drawdowns that affect your psychology and end up you sitting here at the end of the week kicking yourself for the rest of the weekend. So guys, we're going to leave that there because I can tell that I'm starting to ramble now. So if you like the video, please do hit the thumbs up. If you've got any questions, leave them in the comments box down below. Don't forget, if you haven't already, to subscribe to the channel because we've got daily videos coming out, including a sort of what happens in the news type video on Saturday, the technical analysis as always on Sunday, and plenty more next week. So make sure you subscribe. I appreciate you watching. Have a fantastic weekend. Take care, and I'll see you soon.